welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
The core ads business is just doing really well. It's growing in the low 20s%, and it shows you that already in their core business, they're benefiting from AI. So it was really quite a change from 90 days ago, and certainly viewed positively by investors.
Definitely set up September as a key point for the committee. I think the market pricing is about right, the 85% there. You do have two inflation reports, you have two jobs reports before that meeting. So it's possible that it would get derailed, but I think the committee's ready to go.
When the fixed income market, which is forward-looking, and the Fed, which is backward-looking, you have the fixed income market has numerous times reassessed and repriced. So what ends up happening is, as the data, if the data should come out stronger, yields go up. So we do think that we definitely wouldn't buy at this level. Overall, we think yields come down, but we do think it's gone down a little bit too fast, and the market is definitely a bit too dovishness versus what the Fed has guided.
We have got 1 hour to go until the market close, and we are looking at a sell-off in which losses are accelerating here. Let's check on the major averages first. We've got the Dow down more than 700 points, set for its worst drop of the year, in fact, with that almost 2% decline. The S&P 500 down almost 2%, and the Nasdaq, the big loser here, down almost 3%. Now, in terms of what's going on here today, Josh, we did have a little bit of economic data this morning. Seems to be also partially tied into earnings, and then there seems to be some trepidation about tomorrow morning's jobs report that potentially we could get a triggering of the so-called SOM rule, which Jay Powell yesterday called a statistical regularity. In other words, if we see the unemployment rate tick up, that could trigger this indicator that in the past has signaled a recession is coming.
Yeah, I think you nailed it, Joe. I mean, we did have weak economic data today, which is interesting because, and these unemployment claims, it was a manufacturing activity. I was talking to our colleague Josh Schaefer about this in the newsroom, and we're talking about how has there been a shift in the narrative? Because for a while there, for a good stretch, it was bad news was good news, and you see these bad economic data, and investors would think, well, that's disappointing, but it just means Jay cut is going to send that rate cut faster, right?
Well,
and I wonder if now it's just bad news is bad news.
Well, because the thinking was it's okay if the Fed is cutting to get us back to a normalized level, as long as they're not cutting into economic weakness. And now maybe there's a little bit more nervousness about that economic weakness. I want to point out what's going on in the 10-year yield today. It is now at 3.98% here, and that's the first time we've seen a sub 4% yield going all the way back to about February here. So that an important trigger here that the market seems to be watching. And then there's what's going on. I mentioned the other part of it today is what's going on in big tech, right? Nvidia, you win some, you lose some. Up, 13% yesterday, down a quick 8% today. Meta, the standout here to the upside, but otherwise you got a lot of selling going on in big tech.
Some big names after the bell today.
Yes, indeed.
All right, for more on a rough day for the markets, joining us now is Michael Kantrowitz, Piper Sandler's Chief Investment Strategist. Michael, I don't know if you heard that. We were talking here just about that narrative, Michael. Bad economic news was good news for a while because it meant a rate cut was coming. Now, today, Michael, is it just bad news is actually bad news? Is there a change in the script here?
Yeah, bad news is certainly bad news today, and we got a lot of it between claims rising, the ISM declining, remaining in contraction territory, seeing the employment data set at 43, which is, I think, the lowest of since COVID. So, yeah, I think bad news is bad news. I would say, though, that, we started seeing this in May, where when we started getting interest rates falling from late April of this year, when the 10-year was at 4.72, we started getting some bad news. It didn't really hurt large caps and mega caps, but it certainly hit the average stock and certainly it hit smaller caps, which we saw this big dichotomy open up between large and small caps, which then quickly reversed when we got that good CPI report on the 11th of July. And that's kind of given, I think, a lot of investors a lot of confidence. And then we get this string of bad news and it kind of resets to reality.
So where are we in that reality, Mike? Because not only, we mentioned the SOM rule before, which shows that, it's a recession indicator tied to the unemployment rate. You've got your own Cantro rule as well. That's your own homegrown recession indicator. Are we there? Are we getting close?
Mine's already triggered. Mine triggered 3 months ago. And mine looks at how fast unemployment growth, so how many people are unemployed, the pace of that growth rising year on year. And when it breaks 10% historically, and just like the SOM rule, it's been similarly accurate, you are heading towards a recession, or you've always had a recession. And so that broke 3 months ago, and it's continued to rise. And again, it's just more evidence that the economy continues to kind of break down, I think, and maybe that's too aggressive a word to say, but we're seeing, despite lower rates in the last month or 2 months, housing data is not really responding positively. That's not a good sign. PMIs are not responding positively, and consumer confidence is not responding positively. So there's more breadth in this economic softness than we've seen in some time.
And I'm curious, Michael, we got another big economic data point tomorrow, right? The jobs report. I'm just interested in what your expectations are there.
Sure. I'm in the camp, and I'm a strategist. I don't necessarily do point forecasts, but I continue to think the unemployment rate is going to continue gliding higher at a modest pace or moderate pace. And I think what investors are fearful about is a quick acceleration in the unemployment rate, not something we've seen yet. And I think there's several reasons that we won't see that. That again, it'll be more glacial in nature. Number one being that oil prices are not spiking, something we've often seen before recessions and big spikes in the unemployment rate. We still have a decent amount of fiscal spending, and we have parts of the economy that are still holding up for fiscal reasons, or even the housing sector. It's going to take more pain to break that because of the lack of inventory. So I just don't think things are going to accelerate quickly, but I think we're going to continue to see a weaker labor market. The labor market I'm really focused on is next month, when we're likely to see the post revisions, the annual benchmark revisions from the BLS, and that could lead to a major shift in what has arguably been overstating employment, which has been the birth-death model. That could see a pretty sizable downshift next month, and that's something I'm looking out for as we go forward.
Something else that you have been noticing, and we mentioned the milestone today of the 10-year yield falling below 4% for the first time since February. I know you have been noticing the reactivity to moves in the 2-year yield. In a recent note in particular, you were looking at correlations between all kinds of things and the 2-year yield, from everything from small caps to utilities to other groups here, and noticing perhaps that some of these groups, like the small caps, are taking their cue more from the 2-year yield. In other words, benefiting when we see that yield go down, and that's an inverse small cap chart, looking at it moving very much correlated to the yield. What does that imply, that the 2-year is sort of taking precedence?
I think it's just a natural shift of what was driving interest rates for the last couple of years was really the inflation and economic growth backdrop. And now that we're getting closer to the first Fed rate cut, which we agree it's in September, although I would argue I think the Fed should have started cutting already. But I think it's just the market more focused on what the Fed is going to do, more so than what the economic data are doing. What I would in that note, I more broadly discussed, though, that the last 3 weeks, not including today, much of that decline in interest rates has come from the good inflation report we had earlier this month, whereas today we've broken 4% on the 10-year, the 2-year yield's down a lot, 5-year yields are down a lot, but that's because of bad data, and so you're seeing a very negative reaction from markets. And so when yields go down, it could still be a good thing going forward if it comes from lower inflation, but if it comes from higher unemployment, bad PMIs, bad earnings, bad macro data, while that was good news a year ago when everyone was worried about inflation, that's not the case today, and I don't think that's going to. We're going to see that as good news going forward.
Michael, I think the last time you were on the show, you were a fan of utilities. I think, if I remember, Michael, you referred to Iron Man football. That sector, it's kind of like offense and defense.
Good memory, Josh.
You still a fan?
Absolutely. In fact, while everyone's been cheerleading small caps, not everyone, but many have been cheerleading small caps for the last 3 weeks. I've been arguing that utilities is really the place to be. And as of today, as we sit here today now, utilities have actually outperformed the Russell 2000 since the beginning of that rotation, which started on July 11th. So you've been better all year being in utilities rather than small caps. They're beating them year to date. And even from this massive record-breaking move in small caps that really was 4 days in length from the 11th to the 16th, it's been utilities that have continued to work. And I think that makes sense because that's the part of the market that is much more stable, that tends to outperform when risk is rising in the economy and doesn't have the earnings and economic risk that a smaller cap companies do.
Yeah, indeed, that utilities group in the S&P up about 16.5% year to date. I cannot tell you, Michael, how much discussion the Ironman trade has engendered around the office here at Yahoo Finance. That was a popular one to talk about. So thank you for bringing us that once again.
Yeah, thank you.
Good to see you. Thank you. We're less than an hour away from a slew of major earnings reports from Wall Street. Let's take a look at some of the expectations heading into these prints. And here to explain Yahoo Finance's Dan Halley. Dan, let's begin with the biggie. Let's talk about Apple here and what to expect.
Yeah, Julie, there's a lot of anticipation around specifically Apple's performance in the greater China region. This has been a point of contention among analysts, some saying that Apple's gaining share, some saying that it's losing share, some saying that overall smartphone sales in the region are doing well, but Apple's just not catching up. But let's break things down first overall. So for revenue, we're expected to see $84.4 billion and EPS of $1.35. That would be up from the $81.7 billion and $1.26 that the company saw in the same time last year. Now, it's also important to point out that this would be potentially a jump year over year if they do get that number versus the slowing growth decline year over year that we had saw in overall revenue. But let's talk about the greater China region. Analysts are expecting $15.2 billion out of that region. That would be down 3.1% versus $15.7 billion. Overall, iPhone sales are going to be $38.9 billion. That would be down 1.8% from the year prior. So those are really the biggest numbers that we're going to be watching for Apple, though there could potentially be some bright spots, specifically in services, which is always an important number for Apple. It's their second largest category. Estimations are for $23.9 billion. That would be up from last year. And then for iPad sales, that's expected to come in at $6.6 billion versus the $5.7 billion in the quarter last year. And that could be due to the iPad Pro release with that M4 chip inside, higher average selling price, which could lead to also better margins on iPad as well. And then, Mac sales are expected to be down year over year, as are wearables. So, that's really Apple's go-to. On the phone call, we'll be expecting to hear something from Tim Cook on Apple Intelligence, potentially the rollout there. And then obviously we're anticipating the iPhone 16 to come sometime in December. On the other side, we have Intel. Now, Intel, at least according to Bloomberg, is expected to start doing layoffs shortly, which could be in the thousands of workers. They're really trying to reinvent themselves, or at least reclaim what they were as far as market share in the PC market, as well as catch up in the AI data center space and become a rival, a foundry rival to TSMC. So far, the foundry, obviously, it's just getting off the ground with third-party customers. Microsoft is going to be one of them. Right now, Intel's biggest customer is Intel, because they're still making the majority of their chips, so they're not really flying high there. But as far as the top line numbers, we're expected $12.9 billion in revenue and 10 cents in earnings per share. That 12.9 would be flat year over year if they come in there, and the EPS would be down from 13 cents that the company had seen last year. Now, on the data center side, which is what everybody's going to be looking at because it relates to AI and everybody wants to talk about AI. They're expected to bring in $3 billion. That would be down 2.6% versus the $3.1 billion they saw in the year prior. The data center is where they sell their server CPUs and server GPUs. And then importantly for Intel is their client side. That's still their biggest segment which is where they sell CPUs for enterprise and consumer customers for desktops and laptops. Out of there, they're expected to see $7.5 billion in revenue. That would be a jump of 6.1% from last year when they had $6.7 billion in revenue. But one of the important things to point out is that Intel is potentially facing an existential threat from Qualcomm. They jumped into the PC space deeper now. They had been in there for a little bit, but now they have a real product that can compete in their X Elite Snapdragon chip for PCs. It really is an incredible chip inside Microsoft's Surface devices. Intel's expected to launch, though, its own rival chip later this year.
Dan, thanks very much. I know that you're going to be very busy in just a little while here. Appreciate it. We're just getting started here on Market Domination with what will be a big day headlined by big tech earnings. Before we get there, we've got a jam-packed hour ahead for you. Coming up, Nick Timiraos of the Wall Street Journal joining us to break down the path ahead for the Fed. Plus, we'll be speaking to the CEO of IXIC and Wingstop as well, following their latest earnings reports. And we'll also hear from the U.S. Secretary of Transportation, Pete Buttigieg, in his latest proposal to lower the cost of flying. All that and more when Market Domination returns. The Fed is leaving rates unchanged in July, but the likelihood of a September cut seems to be increasing. At least that's the perception. Fed Chair Jay Powell saying a cut could come as soon as the next meeting. For more, we're bringing in someone who was at Powell's presser. That is Nick Timiraos. He's chief economics correspondent at the Wall Street Journal. Nick, it's good to see you here. So, as always, the Fed chair tried to not say explicitly September is happening. The market is taking it that way. We're seeing swaps traders now pricing in 3 cuts still this year. Do you think that's the right interpretation here?
Ask me after the payroll number comes out tomorrow. Yeah. It's hard to say. Markets have to take a view of what's going to happen down the road. I don't. What I would say is that I thought Powell came as close yesterday as he could to saying September without making some promise that someone could hold up later if for whatever reason they decided not to do it. And I'm not sure why the communication came out that way. But nevertheless, I mean, if you look at the policy statement that came out at 2 p.m., sometimes when the Fed is ready to cut rates but isn't doing it at that meeting, they'll put something in the guidance. Yesterday, they could have weakened the guidance around, we won't cut rates until we have greater confidence. They could have said until we have some greater confidence. They chose not to do that. In his opening statement at the press conference, Powell also didn't say anything new in the monetary policy guidance section of his opening remarks. So he left it all for the Q&A. But in the Q&A, he said it could come as soon as September. So again, I think he went as close to the line of saying, the market's not wrong about September, without actually saying the code words that would make it seem like more of a promise.
Can I get your Nick, your kind of insight, Nick, on one data point that got some attention today? I'm curious. Investors looking at this economic data, ISM manufacturing, Nick, and the unemployment measure sank to 43. It was the lowest since June 2020. I'm just curious, Nick, when you kind of, the economists you read and talk to, if you heard any kind of feedback on that.
Again, I think the number tomorrow just will matter a lot more. ISM. Yes, I realize this employment subindex was very weak today. It's bounced around a bit, both in the manufacturing and the non-man index. But it's one data point that I think is quickly going to be overtaken by a bigger data point tomorrow.
And as for that data point tomorrow, there has been a lot of commentary that the Fed should have cut yesterday. What was your assessment of the committee sort of acknowledging the risks of unemployment slowing further and how they're weighing that?
Well, I think the issue right now on the committee is really one where I think the hawks, people who have been reluctant to entertain cutting, there's a question to ask right now, which is where are upside inflation risks going to come from in an economy where the VU, the vacancy to unemployed worker ratio, is fallen to where it was before the pandemic. You have hiring rates down, layoff rates are low, so turnover is low. To the extent you're worried that people are going to bid up wages by changing jobs, that doesn't seem to be happening. You had a fairly cool employment cost index report on Wednesday. So the labor market, as Powell said yesterday, doesn't seem to be a source of inflation risk. So where, if you're worried about inflation, where is it going to come from? Is it going to come from abroad? Probably not with what you're seeing from the dollar and commodities right now. I think that's the issue right now. The Fed says that the risks are more balanced between their inflation and employment mandate. But I do think the market is looking at it saying, well, we see downside risks much more on the employment side than we see upside risks on the inflation side. And, they're putting their money to play accordingly. Now, back in May, the market only saw one cut this year, and people were talking about, well, is the Fed going to have to go back to having a neutral bias or a hiking bias in the statement? And Powell sort of dismissed that and seems to have been, had that view vindicated. But this is obviously a different situation.
And Nick, you also wrote about policy changes during election years. I'm just curious what you made of Powell's commentary about that topic.
Well, his commentary hasn't changed at all in the 6 years now that he's been Fed chair. I mean, he says the same thing every time the question comes up. No, we don't take politics into account. If you look at what the Fed has been trying to accomplish here, getting inflation down without having unnecessary weakness to the labor market, I mean, that's a really big lift. There's so much more at stake than trying to figure out, well, this election or that election. But nevertheless, the question comes up all the time. I hear it from my readers all the time. Well, the Fed must be doing this. I can't understand why they would cut, or I can't understand why they wouldn't cut. Therefore, it must be politics. If you listen to what Fed officials say, if you look at how they've behaved before past elections, there's no evidence that they take politics into account. I do think it makes their communication more difficult. And so I do think if you're going to cut interest rates, if you're going to start a cutting cycle in June of this year or September of this year, as opposed to next year, then you just have to explain it, very clearly for the people in the back of the room. Make sure they can hear it, why you're doing this, that it really isn't about politics. I think there are some people that the Fed just is never going to be able to convince, and they're just going to look at this and say, well, I can't understand it, therefore it must be politics. And those probably aren't the people the Fed is trying to assuaged with the answers like what Powell said yesterday.
Right, and Powell definitely tried to be very clear in that answer. Finally, Nick, since we have you here, as we talk about all of this policy, monetary policy, we also want to acknowledge the milestone that's happened for you all at the Wall Street Journal with reporter Evan Gershkovich being freed by Russia. I know this has been a big effort on the part of the Journal staff. And so just wanted to acknowledge that and get your reaction. And I'm sure that you and the other folks in the newsroom have been celebrating this today.
Yeah, well, thank you for that. I mean, I'm obviously thrilled. It's profoundly good news. And everybody here is really excited and, very appreciative of what others, particularly in the press, have done to keep attention on this. And of course, everybody in the government who worked so hard to secure his release. I'm happy for him and for him to be reunited with his family.
Definitely. Nick, thank you so much. Appreciate it.
Thank you. Yeah.
Well, switching gears to a trending ticker today, we're talking about online retailer Etsy reporting stronger than expected revenue for its second quarter. Gross merchandise sales were in line with expectations, though they did fall 2% from a year earlier. The online marketplace is looking to boost sluggish sales with the planned rollout of its first ever royalty program. And joining us now is Etsy CEO Josh Silverman here with us in the studio. It's good to see you, Josh. Thanks for coming in.
Thanks for having me back.
So, indeed, talked about some revenue growth, gross merchandise sales falling a bit, and there seems to be a little bit of confusion on the street about the full year gross merchandise sales guidance, which I believe you guys pulled. You don't have that full year guidance anymore. Can you explain to us a little bit more about that decision or just how you're thinking about the rest of the year?
Sure. So we're pleased to see that we actually saw some modest acceleration already in the second quarter. We guided to low single digits for the third quarter, but things have just been very volatile, and so we're really not comfortable giving a fourth quarter guide yet. We have an election that's been incredibly mind share consuming, and I expect, unfortunately, that that's going to get worse in terms of mind share consuming. And the macro, continues to be very volatile. Well, we're pleased that in spite of what we think are very significant macro headwinds for discretionary consumer products, we've been maintaining our position. And we had 91.5 million active buyers last quarter, about very close to our all-time high, while we're swimming upstream. And importantly, we think that this is only making our muscles stronger for when we come out of the recession, doubling down on the things that make Etsy the most special, and importantly, resisting the urge to follow the race to the bottom. Most people in e-commerce right now are just all about deep discounting. That's not Etsy. It's not where we're going to win. We're really about highlighting the very best of Etsy. We've made enormous progress in that. We are excited about the progress we're making there. And we think that's what's going to make Etsy bigger and stronger for a long time to come.
Josh, the way that I use Etsy is probably like a lot of viewers right now use it. So if I want something really just kind of basic and general, honestly, I go to Amazon, right? That's my first stop. And then if I want something just cool and unique and different, I go to Etsy, whether it's for myself or maybe it's a gift, right? How do you think about that, and how do you get consumers to think about that? Maybe think about that differently.
Yeah, so great question. I think we've done an amazing job of becoming the very best place to go when you can't find it anywhere else. Whatever it is you have in mind, if you can imagine it, it is for sale on Etsy and can be made just for you, exactly to your specifications. We have and by the way, for several years during the pandemic, there were a lot of things you wanted and couldn't find anywhere else. Even if, forget offline, even online places were out of stock. So tens of millions of people needed to come to Etsy to buy things that they couldn't find anywhere else. We're really proud of the fact that we've been able to maintain nearly all of that volume, even now, in a deep, what I think is a recession for consumer discretionary products right now. I think we're in one. We've been able to maintain nearly all that volume. But the opportunity for us now is to be a starting point for your commerce need. You can buy a cheap bookshelf somewhere else if you want, but the bookshelf that people are going to comment on.
That I got from Etsy, yeah.
You got from Etsy that people say, wow, that's such a cool bookshelf. Where did you get it? That's only Etsy. Yeah. And so instead of you needing to already know exactly what you need, I need this bookshelf of exact this dimensions, we want you to come to Etsy when you're just thinking, I'm going to redecorate my office. I am planning a wedding. I'm having a baby. I need a gift for a friend. I'm planning Thanksgiving. and have us be having such an organized experience for you that we can take you through, here's all the things we can do for you, from that very high level, very, let's say, low definition need, all the way to specifically the things that you want to buy. That's been hard because with over 120 million things for sale, none of which map to a catalog, organizing that in a way that people can understand is tough. But this is where LLMs are magical. They're really good at taking vast amounts of information and summarizing them and organizing them in a way that humans can understand. So the kinds of investments we're making right now, I think, are really exciting for making Etsy a place you can start for all of your commerce journeys. This loyalty beta we're starting right now, a loyalty program, is really about asking people, hey, pay a small monthly fee.
Right.
And by committing to that small monthly fee, we think those people will then say, well, hey, I'm already paying the fee. I'll start all my shopping missions on Etsy. And you're going to be surprised that we can deliver not only great stuff made just for you, but at good value as well.
I want to double click on what you said about us being in a consumer discretionary recession. Because that, on the face of it, seems to be pretty bad news for a company like Etsy. So you're doing these things like the loyalty program. When does it inflect for you then?
I think we've been the tip of the spear. I think we've been facing this for many quarters now. And now we're hearing, for example, Starbucks having a tough quarter, right? In the last recession, the last thing people gave up on was that cup of coffee. That was that affordable luxury. We're seeing, McDonald's say that it needs a $5 menu meal now because paying full price at McDonald's is too much. So I think Etsy's been feeling the brunt of. Wells Fargo published a survey recently saying 60% of Americans right now say that by the time they're done paying for their essential bills, they have very little left over for anything else.
So will you be one of the first to come out of it then?
I certainly hope so. And we are leveraging this moment to make Etsy even stronger, lean into what makes us different, celebrate the very best of Etsy, elevate the best sellers. We've made huge progress with Etsy Search just in this quarter on increasing the diversity of Etsy sellers, reducing duplication, and highlighting the best, the most artisanal, the most craftsperson-like. And that's a track of work we're really invested in right now. Behind every item at Etsy, there's a human. There's a real person who made that item or designed that item. And we're doing more and more to celebrate and center that seller and her work. I think that's going to pay off in spades, especially as we come through the other side of this cycle.
All right, Josh, thanks so much for joining us today. That was great. Appreciate it.
Thank you very much.
And coming up, it's the latest edition of our series, Goodbye or Goodbye. We're going to take a deep dive into 2 stocks to help you make the best moves for your portfolio. Stick around.
The crackdown on junk fees at airlines, well, that continues. Let's bring in Transportation Secretary Pete Buttigieg. Mr. Secretary, always nice to get some time with you. Another real interesting initiative by the Department of Transportation. My question to you is this with these fees. How much are airlines, I guess, bilking passengers with these? Like, how much does this become a profit center for these companies?
So what I can tell you is that we've gotten hundreds of complaints about cases where this has happened. And it may not be the #1 category of complaints in terms of volume, but it's certainly one of the most troubling in terms of severity. The idea that you get into a situation where you got to pay extra just to sit next to your kids. And I think consumers are already kind of grumpy about the practice that has developed feeling like you're nickel and dimed for every service on board a plane. But we're talking about something much more serious than that. Just think about how frustrating, even scary it could be if you are separated from your kids in flight, and how challenging it can be if you are told that either you got to pay or you find yourself haggling with another passenger and pulling a flight attendant into this as you're kind of begging or bargaining to be able to sit next to your kids. Parents shouldn't have to deal with that. I feel even more strongly about that now that I've flown with my husband and our toddlers. That is a challenging thing enough without facing this. So the rule would make it clear that when you fly, there's no extra charge to be sitting with your own kids. A number of airlines have answered our calls and are already doing this voluntarily. The rule would make that standard across the industry.
Mr. Secretary, we talked to a lot of CEOs of publicly traded airlines here at Yahoo Finance. Do they know this stuff is happening? Are they sitting in their bar rooms like rubbing their hands like, gee, how can I get more profits out of each passenger? I mean, or are they just, I guess, not surprised by this at all?
I've definitely raised this directly with some airline CEOs. They don't seem to view it as the problem that we do, but we're guided by the complaints and the input that we're getting from passengers. By the way, like all rules of this type, this is going to go to an open comment period where passengers can weigh in. Airlines can weigh in too. Look, they have been fighting us on a lot of these rules, right? We did fee transparency. We've done automatic refunds. We're doing ancillary fees where you got to at least be able to get your money back on the Wi-Fi if the Wi-Fi didn't work. And it is frustrating when the airlines push back. Notably, they have gone to court over the rule that we have on fee transparency. Now, to me, if you're going to court of law saying that it will irreparably harm you to have to disclose the fees that you charge, to me, you're kind of telling on yourself in terms of your business model. But that's the posture they've taken, and those processes will work themselves through. But what we do know is that passengers appreciate these passenger protections, and I would argue they ultimately make the airline sector better off too, because they build confidence in that sector instead of passengers being so frustrated all the time.
Also, Mr. Secretary, we talked around the time of the door blowing off that Boeing airplane. Now, yesterday we had big news. Boeing has announced a new CEO, Robert Ortberg, a veteran of the aerospace industry. When we talked last time, you said something like that is a personal issue for you. Have you scheduled a meeting with Mr. Ortberg, and what's your message to him as he takes over the helm of this iconic American company?
I haven't yet arranged to speak with the new CEO, but of course we'll be watching that leadership change closely. We don't pick and choose hiring decisions for a company like that, but we are going to stress the importance of establishing the right kind of safety culture. And when I do get the opportunity to speak with him, that will be my focus. I'll want to know what steps he thinks can be taken and what he is committed to leading in order to make sure that Boeing puts safety and quality first. There's been a lot of focus on the analytics and the economics. All of that, of course, is important for any company, but none of it means anything if you don't have safety and quality first.
We've covered your whole time at DOT, Mr. Secretary, from start right up until now. I only know you as a Department of Transportation Secretary, but you've now been rumored to be in the running for Vice President. I know you can't say much because of the Hatch Act. I get it. But to the CEOs that watch Yahoo Finance, could you just tell them or speak to them about the economic agenda of I guess, the Biden administration and how pro-business is the Vice President?
Well, without getting into the campaign side, what I'll say is that you can expect a continued focus in this administration on sustaining the historic economic growth and job growth that we've experienced. I think this administration has demonstrated that you can be pro-worker, pro-consumer, pro-competition, pro-little guy, and business thrives too. I mean, that's the thing. It's not like profitability has somehow collapsed because we've been supporting workers and unions and better wages and the rest of it. On the contrary, everybody has been better off. Jobs are up. Companies are doing great at a time when we are also showing how serious we are about those labor protections and consumer protections. These things can go hand in hand, as they have for the last 3.5 years. And the vice president, under the president's leadership, has been a key architect of that.
Lastly, I'm glad you mentioned infrastructure, because your administration, the Biden administration, and you have led a lot of these efforts, Mr. Secretary, in the EV industry. And you're going to, I believe, be visiting a Stellantis battery factory tomorrow. As you take a step back, do you just find it bizarro that Elon Musk is not out here supporting the efforts of the Biden administration, and that he's throwing his support behind President Trump, who may come in here if he wins 4 years in the White House, pull back that EV tax credit, and maybe undermine a lot of the EV investments that this administration has made?
Yeah, again, I'll take care not to talk about the campaign side of things, but this administration has seen to it that the EV industry has flourished in this country, whether we're talking about new companies like Tesla or whether we're talking about some of the most traditional names in auto manufacturing in the big three, making their moves to thrive in the EV future. And we're doing this because we know, not of course because there's climate benefit and because there's benefit to our economic security. Just like China has worked to edge us out in the EV market, not, I think, because they are environment enthusiasts, but because they understand the strategic gains. We have gained so much ground, and that's part of what I'm going to get to see tomorrow in Indiana. I first spent a lot of time in Kokomo and in Howard County, Indiana. During the time of the Great Recession, the auto crisis in 2009, I saw what it was like in that community as they were facing almost 20% unemployment and were worried that that unemployment rate could hit 40% if companies like Delphi and Chrysler went under. It's part of how I got into politics to begin with, was standing up for the rescue that kept Chrysler in business and kept really so many families in Indiana on their feet. So it's an amazing full circle moment to go back to this place that was experiencing such economic pain when I first got deeply engaged there, and now has a new factory because of the focus on EVs and the jobs associated with them taking shape that will mean not just the people who work there, but thousands of people in that community are going to benefit. And it's a great example of how this administration has broken the old false choice that you either care about climate or you care about jobs, and instead has demonstrated that you create jobs by leaning into our clean future.
Great to get some time with you, as always. Transportation Secretary Pete Buttigieg. We'll talk to you soon. Good luck on that trip to the Stellantis plant. We'll talk to you soon.
Very much.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a deeper look into the market-captivating tech sector. I'm here with Headline Venture partner Cameron Ansari. Cameron, it's good to see you. Thanks for coming in.
Good to be back.
Let's take a look here. Your goodbye today is Microsoft. It's an interesting one, of course, because it just reported. The market punished it a little bit, but the shares are up more than 20% over the last year. This sort of sell-off that we've seen notwithstanding. And I know you like big tech generally, but so we'll use Microsoft sort of as a representative, right, in this case. And the valuations have come in, as I mentioned. Microsoft got punished after its earnings, but generally we've seen tech stocks come down.
Oh yeah, look, I mean, Microsoft itself, obviously big run up this year. They're down 10% almost in the past month. So I think it's an opportunity for folks to come into these big names, the FANG names, the Magnificent Seven, however you want to define them. They're all down about 5 to 10% in the past month or so. You're talking hundreds of billions of dollars of market cap kind of wiped off very casually as investors have rotated to more kind of Russell 2000 and traditional sectors away from tech. So I think it's a buying opportunity because these companies are still doing tremendously well and you buy and hold and stick out for the long term.
And maybe the valuation's now a little more in line with that kind of outlook. That said, the rotation, you think, to that non-tech, you think it's gone too far at this
Absolutely.
point?
And I think people are spooked by some of the CapEx they're seeing and the numbers from Microsoft, from Alphabet, from Meta, where Microsoft, I think, is projected to spend something like $80 billion in the next year in CapEx. That's roughly the GDP of Luxembourg. That's a massive number, right? And it scares people, but the truth is, we're in the early innings of the AI revolution, and I think, you don't build a house by putting in the fixtures and the paint and the art. You put in the concrete, the foundation, the steel, and that's what these companies are doing. They're spending now for the future. So it's going to be a heavy CapEx period, but I think you buy and hold these names for the long term.
Okay, and let's talk a little bit more about that, laying the foundations for AI here. So is there, though, a situation, as they're building the foundations, they're also going to be revenue generating?
Sure.
So when do we look for that next phase?
And it's already there. The intelligent cloud unit of Microsoft, which is where most of the AI business sits today. I think the street projected $28.7 billion. The quarter came in at $28.5. They missed by inches, but this company's still ahead by miles. So let's not, I think, lose that perspective.
Gotcha.
So the revenue's there too. It's going to be on the come, right? A lot of the revenue from the AI businesses in these companies is still going to be forthcoming.
That said, it's not without risk. We always like to point out what could go wrong here. And we could see a continued rotation. There's been a little bit of trepidation, too, that the AI story, leaving even the stock prices aside, was a little overdone.
Was overbought, and people kind of got too excited about it. And I think, it is going to be maybe one of these things where it's kind of, 2 steps forward, 1 step back, where investors are going to take a moment to pause and move to other sectors and maybe safer spaces. But I think, again, if you buy and hold and look, zoom out for the long term, these are great investments. These companies are built to last.
So let's talk about the stock you do not like as much, and that is Groupon, which, to be honest, I haven't talked about in quite a long time.
I know, neither did I.
These shares are actually up quite a bit over the last year. If I pulled out this chart longer, though, it would be a collapse in the shares over the past 5 years and over the maximum time. But we're seeing this at a time when, and we have a chart of the company's year-over-year revenue here. So this is the annual revenue going back to 2019, and you see.
I'm not even sure what else to say. This is not a great chart. They're exiting businesses. I think this is a business in transition that's slimming down. It almost feels like a business that's trying to kind of narrow down to just a couple of business lines that they feel are going to be profitable and push forward. But again, the entire company has shrank, and it's just the story is not a great one in terms of declining year-on-year revenue.
Right. So the revenue is declining, but also they've got net losses.
The surprise net loss they hit in Q2, which I think folks didn't expect. They were profitable the prior quarter, and all of a sudden they had a $10 million net loss in Q2. Some of it due to, I think, a write-off related to their closing down their Italian business. So I think, again, this business is one that's slimming down, that's shrinking, that's declining, and I think you're going to see that reflected in the stock price.
Yeah, and then there's sort of the, existential issue around Groupon also.
Like, who are these guys anymore, right? Like, it's like, if you want coupons and stuff, you're going to Retail Me Not or Ebates or these other sites. If you're doing online shopping or social shopping, you're probably on Instagram or TikTok or Pinterest or somewhere else. I don't know where Groupon really plays anymore in sort of the consumer tech stack, the totem pole of the apps you go to on your phone every day. I just don't think Groupon's in that conversation anymore.
So what could go right for Groupon? Maybe somebody buys them?
I think maybe someone comes along and buy. If you buy this asset, restructure it. I mean, the brand is still a well-known name. It probably sits on tens of millions of phones out there that have the app that maybe don't open it every day, but haven't bothered to uninstall it. So it still has a lot of users, customers, accounts. App downloads, and I think if someone came in and bought it, restructured it, that could be an upside for this stock, and it could drive it up.
Gotcha. Do you have a position in either of these stocks?
I do not.
Okay, all right. So buy Microsoft, avoid Groupon at this point. Cameron, good to see you. Thanks for coming in. Appreciate it.
Thank you.
And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern. Stay tuned. We've got more market domination on the other side.
Wingstop delivering appetizing growth of nearly 29% in same-store sales for the second quarter. The restaurant chain now eyeing a new average unit volume target of $3 million. Wingstop CEO Michael Skipworth joins me now to discuss, along with Yahoo Finance's very own Brian Sozzi. Michael, it is good to see you. Michael, you look at the stock, it's slipping a bit today, but listen, it has been a rocket ship. It's up about 45% already this year. And I looked through the report, Michael, Q2 domestic comparable sales beats. You boosted forecast for that metric. Walk us through the quarter, Michael. What drove the business?
Yeah, Josh, I think our Q2 results that we reported yesterday really showcased Wingstop operating in a category of one. We grew same-store sales 28.7%, and it's important to note that same-store sales growth was primarily driven by transaction growth. Our supply chain strategy is working. We're delivering predictable food costs to our franchisees. They're making a lot of money, and they're opening up a lot more restaurants. We set a record in Q2 of 73 restaurants. So we're excited about the results translating to a really strong EBITDA number that we delivered, a record quarter for the brand.
Michael, it's Brian. Good to see you as always. You know why I always talk to Wingstop, why I've covered the company since its IPO many years ago? Well, it is one of the growth stories, the lone growth stories in a fast food industry that, in my opinion, is falling apart. Your stock's up about 300% in the past 5 years. If I'm right, you just took your long-term growth target for stores from 7,000 to 10,000. There's not a lot of companies in fast food doing that. So my question to you is, how sustainable is your growth profile?
Brian, we have so much momentum in the brand right now. Just a few years ago, we set an average unit volume target of 2 million. We already hit it within 2 years by continuing to execute against strategies that we believe have a ton of runway in front of us. That supports our new target of $3 million in average unit volume. Our footprint, we continue to expand. In the last 12 months, we opened 300 restaurants. So I think that really speaks to how the brand is resonating with consumers, and more importantly, just how strong those returns are for our franchisees who have a desire to open more Wingstops. As of the end of Q2, our pipeline for new restaurant development is the strongest it's ever been. So it gives us a lot of confidence in our ability to scale Wingstop to over 10,000 restaurants globally.
Mike, I'm curious to get your take on the consumer right now as well. You have unique insight there. Any changes in consumer behavior, Michael?
I think for Wingstop, we read and hear the same things you do about what other brands are experiencing, but at Wingstop, it's different. We saw growth across all income cohorts for the second quarter, and we actually saw for the first time in my 10 years with the brand, we actually saw an uptick in frequency. So within that 28.7% same-store sales growth, I think we're just in a completely different category than other brands right now.
Michael, your same-store sales, talking to a couple of folks on the street, they've never seen anything like this before. McDonald's U.S. sales didn't even grow. Wendy's reported earnings today, just to hit a few tickers on Yahoo Finance. You're up almost 5 times. Your same-store sales were 5 times more than Wendy's. What is it about a chicken wing? What is it about a new chicken sandwich? Because the consumer is essentially saying they don't want what McDonald's is selling. They don't want what Wendy's is selling. I mean, what is it about what you guys are pumping out around the clock?
I think, Brian, what we've heard from the consumer is they are prioritizing value and quality when it comes to making decisions around how to spend their dining out dollars. And that plays beautifully with that Wingstop indulgent occasion. And we've been measuring record levels in both value and quality with guests. And I think you're seeing that show up in the business. And I think consumers are continuing to come back into the brand. And we're seeing something really exciting in that we're continuing to bring in a record level of new guests. But these new guests look a little bit different than our traditional guests. And they're coming back to the brand quicker for that second visit. And they're actually moving up the frequency curve faster, which gets us pretty excited about our ability to deliver on our outlook for this year, which, Brian, would mark our 21st year of same-store sales growth.
Michael Skipworth, Brian Sozzi, thank you guys both for joining the show today. Appreciate it.
Thank you.
And while wrapping up today's market domination, don't go anywhere because the earnings fun is just about to get started. Got you covered with all the numbers from Amazon, Apple, Intel, and many more. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it's market domination overtime. We are moments away from the latest earnings from Amazon and Intel. But first, let's see where the major averages ended this session. Deeply in the red is the short answer to that question. The Dow finishing off the lows of the day, though, down by 496 points, 1.2%. The S&P 500 off 1.4%, and the Nasdaq off by 2.3%. And with me here on set is Yahoo Finance's Josh Schaefer as we look at the day that was and as we await these earnings coming out. It was really an interesting day, Josh, because as we talked about, and actually Josh Lipton cited you earlier, talking about this sort of narrative or vibe shift that seems, it's been happening over the past few weeks, but something seemed to shift today in particular.
Well, it felt like we've been waiting for at what point does bad economic news become bad news for stocks, right? And I think today you could definitively say that happened. Whether or not it sticks moving forward, anyone's guess, right? Michael Kantrowitz over at Piper Sandler sort of told you guys earlier in the hour, he thought that was going to be the case and that is going to stick. But I think you take a look at something like the Russell 2000 today. That has been our favorite trade to look at when talking about Federal Reserve interest rate cuts. Today you have a sharp move for the market to price in more interest rate cuts. We're getting closer to the market pricing in 50 basis points in September, and the Russell falls over 3%. That was not the move that we saw in July as the market priced in more cuts, right? So you had sort of a stark shift there. And it seems like we're sort of in that regime, at least for now.
Well, and the irony is that economic reports we got today were not big economic reports. Jobless claims set an 11-week high, but economists said there were lots of seasonal sort of anomalies.
They always go up in the summer.
Right.
If you look at the chart, it always goes up in the summer.
So that's not necessarily a super clear signal. And even the ISM manufacturing was a little bit mixed because you saw certain components of it did improve. So really, it seems like it's also trepidation over the jobs report tomorrow.
Right, yeah, it sets the table for a very big July jobs report tomorrow where expectations are for the economy to have added about 175,000 jobs, the unemployment rate to stay flat at 4.1%. Net, that's a pretty good print overall. The question is if that doesn't happen, right? You guys were talking about the SOM rule earlier. If we get unemployment at 4.2%, that recession indicator hits, that's going to be sort of the key concern going into tomorrow, but it's going to be fun at 8:30.
It will be fun. But guess what? It's going to be fun right now, too,
Let's
Josh.
do it.
That's because we have numbers from Amazon reporting its second quarter results and giving a forecast as well. The forecast seems to be disappointing. I'll get to the details on that in a minute, but the shares are down a quick 3.5%. The company's second quarter AWS net sales rising, excluding currency effects, by 19%, coming in at $26.28 billion. That better than estimated. Earnings per share at $1.26, beating by 22 cents a share. And that and the operating margin coming in ahead of estimates as well. Physical stores net sales a little light of estimates at $5.21 billion, but North America net sales overall at just over $90 billion, beating estimates. So that is the second quarter. Moving to the third quarter forecast here, the company says net sales will be in a range of $154 to $158.5 billion in the third quarter. That leaves the midpoint of that forecast lower than the $158.4 billion that the average of analyst forecasts was looking for. Operating income as well. This a little more clearly below estimates. Third quarter operating income, the company is saying, will be $11.5 to $15 billion. Analysts had been predicting almost $15.7 billion. So that explains the drop that we are seeing in the shares in today's session. And by the way, the stock was already down 1.5% in today's session, as it has definitely participated in the broader tech sell-off that we have seen. I'm just looking here. The stock was at a record high back on July 2nd. It closed there, and it's down 8%. Then since then, going into this report, Josh?
Well, when you look at the broader market action and sort of a bias to maybe rotate out of large cap tech, Julie, I think you get a clear reason, at least on the initial print here, for investors to say, okay, if I was waiting on that report today, Amazon didn't do nearly as bad today as some of the other mega cap tech stocks leading into the report. Maybe some people waiting to see what we hear. Now you get the news that sort of confirms maybe part of that rotation. The guidance you pointed out is going to be interesting to hear more on the call from Amazon. Obviously, when you talk about Amazon's net sales, they sell a lot of different things, and sort of what they're concerned about, I think, might be the most interesting thing to me, because there are different reads you can get from Amazon in terms of ad sales, in terms of the cloud business, in terms of the overall U.S. consumer. We were just talking about kind of the state of the overall economy here, and there is sometimes a read-through from Amazon's earnings report and commentary on the call with what they're saying about just what people are buying. A lot of us buy things on Amazon every single day. Are they seeing any slowdown in that kind of sales? Where is the sales slowdown coming from, I think, is the biggest question. And usually the street cares if it's coming from something like AWS.
Right. It's a good question. Andy Jassy, the president and CEO, saying in the statement, really emphasizing we're continuing to make progress on a number of dimensions, he says, but perhaps none more so than the continued re-acceleration in AWS growth. Now, as I mentioned, that growth was about, 19% in this last quarter. So we'll look for any kind of guidance to see if that is going to continue, if that's going to accelerate more, and what part of that guidance, to your point, is from AWS in particular. It's not in the statement, but we well could get some color on that from the call.
And the other question here, too, is just how much they're spending, right? That's been the key question with all of these tech companies. It comes up on the call every time. How much are you increasing CapEx? You're going to be spending more in AI. Why am I not seeing the spend in AI come back in things like revenue or things like margins or operating income is sort of the broader question here, and one that they're obviously going to, or analysts are probably likely going to ask about on the call. But I think that's one of the key looming questions here with that AI narrative, because we have to mention AI.
Yeah, I mean, he mentions generative AI in his statement as well. He talked about it leveraging new generative AI opportunities. So we'll get more on that, I am sure. We also had the latest earnings out from Intel as well. Those shares are also taking a leg lower. For that, we go over to Yahoo Finance's Akiko Fujita, who's got those numbers. Hi, Akiko.
Hi there, Julia. Certainly a tough quarter all around for Intel, and you see that reflected in the stock here, down more than 10% in after hours. But let's start with the big headline coming out of this release here in the quarter, with the company saying that it plans to, it's reducing costs by $10 billion, a 15% headcount reduction that amounts to 15,000 jobs. Remember, we had just gotten that report from Bloomberg yesterday about the thousands of layoffs here. And this really is about the scenario that we've been hearing from Intel, significant investments having to go into the foundry business. And now, as a part of that discipline, the company announcing these significant cost cuts, $10 billion again. But let's walk through the numbers here in the quarter. A miss on revenue here, $12 billion. The expectation here was $12.95 billion. Adjusted EPS coming in at 2 cents. Estimate was at 10 cents. Looking at individual divisions here for the company, client computing revenue, which is, of course, the largest part of Intel's business. This is about the chips for enterprise consumer computers. That was a miss at $7.4 billion. The street was expecting $7.53 billion. Data center and AI revenue, that's one that investors have been watching closely, obviously, because Intel has really trailed some of its competitors, especially in its AI business. That coming in at $3 billion. The estimate was for $3.07 billion. And then the Intel Foundry business here. This is the one that has just been really capital intensive. And Pat Gelsinger, CEO, has really messaged this, saying that this is going to be a long-term investment. $4.32 billion here is the revenue coming in the second quarter. $4.47 billion was the expectation. And when you look at where things are looking in Q3, certainly not much better here. And I'll read you what Pat Gelsinger has been saying here, at least in the release. He says our Q2 financial performance was disappointing, even as we hit key product and process technology milestones. But second half trends are more challenging than we previously expected. We are leveraging our new operating model to take decisive actions that will improve operating and capital efficiencies. The company now guiding to an EPS of 3-cent loss. The expectation was for 30 cents a share. So, guys, I'm looking through the numbers here. I mean, the headline really is about that $10 billion cost reduction, 15,000 jobs now being cut. And again, this company really undergoing a multi-year transformation, but certainly not looking good, at least in after hours right now. When you look at shares, they're down more than 11%.
Yeah, and Akiko, something else to point out is the company, starting next quarter, is going to be suspending its dividends. So those who had been the Intel faithful, right, who were holding on for that foundry business after the long capital-intensive build-out to bear fruit, they were getting a little carrot there to hang on, and they're not going to be getting that carrot anymore as of the fourth quarter, because it seems as though Intel feels it has to take these steps to preserve cash.
Yeah, I mean, you bring up a good point there in the suspension of that dividend, certainly significant for shareholders here. But look, Pat Gelsinger has been messaging this for some time. In recent weeks, he was, speaking to another network, saying that essentially that 2027 is when they expect to break even on the foundry business. As you know, Julie, this is not an overnight turnaround. And this is a company that is trying to go from fabless to foundries and invest significantly there. So it's going to take a lot of patience on the part of shareholders. But you're certainly right. That carrot was there in terms of the dividend. Now that being suspended, as well as Intel really, again, tries to balance these costs for the long term with where things are with the business right now.
Yeah, definitely. Thank you so much, Akiko, for breaking that down for us. Appreciate it. Well, for more on Intel and all of the announcements we just talked about, that $10 billion cost reduction plan, the suspension of the dividend, and a forecast for revenue that's below estimates, let's get to Matt Bryson, Wedbush Securities, Senior Vice President of Equities Research, covers hardware here. Matt, is this worse? I mean, the stock reaction would indicate this is worse than the street was expecting. It seems like expectations were pretty low, and Intel managed to miss even those.
I think that's exactly right. I think in the near term, there was maybe a little bit of hope that the PC market is a little bit better than expected. We saw last year a bump in that market was enough to get Intel some better numbers. And now, not only are they guiding for flattish revenues, so there really isn't a second half bounce, but then you have concerns around, if they're cutting costs, what does that do to their longer term strategy?
Matt, I'm curious, when you look through the report here, obviously highlighting a lot of things that just simply missed estimates there and sort of came in worse than expected. What is sort of the turnaround case here? Are you seeing anything within the release that gives you a little bit of promise here?
No, I mean, part of the problem with Intel is that if they get things right, you really are looking at 2-3 years out when they see the fruits of their investment. So them catching up to Taiwan Semi, that's really a 2026 story, 2027 story. And for them to turn that into revenues on the foundry side, that's more like 2028. And so I think the hope had been you get a little bit of rebound, a little bit better execution in some of their core businesses, PC in particular. And then, longer term, you have that promise that if they can get close to Taiwan Semi, then they have some advantages in those businesses. And now, it's a long ways away to wait to see if Intel is truly executing on what they're trying to do.
These new cost reductions that the company is announcing, does this feel like the right move for them, or does it feel like something they had to do? How are you reading those?
So Intel is a big company. It's been a big company. I think that there is room for them to be more efficient. Certainly when Dave, the CFO, was over with Micron, he did a great job managing expenses and managing investment at that company. And so I think that certainly a leaner Intel is a possibility and may not be a bad thing. At the same time, Pat Gelsinger came into Intel with the premise that they did the wrong thing in underinvesting, and that they were going to invest to catch back up. So when you start cutting back on investment, then you wonder, does that potentially create a bit more of a threat that they don't execute to where they're trying to go?
Matt, I'm curious where you feel like Intel sits as far as the AI narrative goes here and what the AI story is for investors. What are you seeing from that perspective, and is that still part of the reason to be maybe looking to get in on a dip here in Intel, or is that just too far into the future at this point?
I think it's far away, and I think in part, if you look at what Nvidia has done, right, they've taken that gaming architecture with their GPUs, and they've translated to the data center, and they've spent a really long time doing it. If you look at what AMD's doing, it's very similar, right? It's a GPU that was a gaming product. Now it's an AI product. Intel approached things from a different point. They came in with something called an IXIC architecture, and they haven't gotten a lot of traction. So that doesn't mean that in 2025, when they come out with Falcon Shores, which is their next product, that they aren't necessarily a competitor. But again, it's a wait and see type story, and it probably plays out in 2026, 2027 if they're successful. So it's a ways away in terms of them really benefiting.
Matt, just real quickly here before we let you go, what would you do as an investor looking at these numbers? I believe you're neutral on the name, so presumably you're not coming in to buy the dip here. Would you go in the other direction?
I mean, I think it depends in part on what your investment time frame is. But again, if I were in Intel from a shorter term perspective, I mean, it seems like a rebound is some ways away. And I guess the reason I'm neutral is from a longer term perspective. I don't have conviction yet that they've gotten things right, that things are turning around. So it's hard for me to recommend that someone buys it for a 3 or 4 year with a 3 or 4 year time horizon because I just don't know.
Right. Yeah, fair enough. Matt, thank you so much for your perspective. Appreciate it. And let's turn back to Amazon now. Shares of Amazon are edging lower after second quarter revenue missed analyst expectations. And the company, more importantly here, is coming out with the third quarter forecast that missed estimates as well here. Joining us now to discuss further is Nick Jones, Citizens JMP Equity Research Analyst. Nick, thank you so much for joining us. First of all, just give me sort of your first blush, big picture reaction to these Amazon numbers.
Yeah, big picture. It was great to see AWS outperform. A little weakness on the top line marginally, and really the guidance came a little bit as a surprise given the AWS strength. So really, the focus on the call is going to be what are the inputs to the 3Q guide. I think investors were also looking for better kind of operating income margin guidance than we got. So that's kind of my first blush when I look at the results. But overall, I think the results are down the fairway and really need to focus on what the inputs to the guide are.
Nick, I know we're still waiting for the call, but I'm curious, when you do look through that report, I mean, do you have any idea what the inputs could be here? Was there anything that sort of caught your eye as a point of caution in terms of what would have brought that guidance a little bit lower than expected?
Yeah, international actually looked a little bit weaker. In the press release, they called out a record Prime Day. We've heard some from Etsy and eBay that there was some weakness in Europe related to elections, Euro Cup, the Olympics going on. So there could be some distraction and different allocations of people's discretionary spend right now. But international was a little weaker on the quarter, so that could be part of the inputs into the guidance. And we've been hearing this narrative of folks really looking for steep discounts and being a lot more discerning with how they're going to spend their money, which probably is why Prime Day was such a great day, is people were looking for steep discounts. So my inkling is that it's more on the retail side, more so than AWS.
And as you look at that too, and as I look at the quarter's forecast, it seems as though yes, sales guidance is light, but it looks like the gap is bigger between expectations for operating income and the operating income forecast here. So does that mean, we know that Amazon likes to sort of reinvest in the business at different points in time. It pulls that lever. Is that what's going on here? Are we seeing some investments in the business?
Yeah, I think so. Amazon's still got global expansion opportunities. They continuously want to deliver things faster and faster. It's a really unique company, too, when you think about their advertising opportunity in combination with the retail. They're able to advertise at the top of the funnel, kind of winning hearts and minds for brands, and then take it all the way down into the e-commerce platform, execute the transaction, and then ultimately fulfill it to the end user. That's a really unique platform from an advertising perspective, tied right into retail, and then they're really strong cloud business. So while this company is massive today, it's still very much in growth mode.
And Nick, I'm curious from an AI perspective here. We can't go the whole interview without us mentioning AI, right? I have to bring it up. But of course, that's going to come up on the call, right? And Amazon spending there. How are you sort of assessing how much they are spending toward AI right now and when that is going to be contributing to revenues, if it's already contributing to revenues? Like, where is Amazon in that part of the story? And are you sort of comfortable with how much they're spending versus how much they're expecting to see come back within revenue?
Yeah, it's a great question. They've already called out AI being a multi-billion-dollar business. I think the AI investment cycle, and you're hearing from a lot of large players, is you really need to it's better to overinvest than to underinvest. This is a very long-term opportunity that'll infiltrate, efficiencies. It'll start facing consumers. It'll infiltrate advertising. So I think, I'm in the camp that spending more is better than spending less. Again, given that this is still a growthy story here. We expect them to continue winning their share. I mean, really to win in AI, you need huge data sets, you need compute power, you need talent, and you need a lot of money. Amazon has all of those. So I expect them to continue to be competitive.
Nick, thanks a lot for your perspective. Appreciate it. Well, coming up, we've still got plenty of earnings to get to. And we should mention, by the way, as we look at Amazon, as we look at Intel, some of the other numbers that we're getting, we are seeing a lot of selling in the after hours in reaction to these numbers. Does that set us up for another ugly day? It's all going to hinge on jobs in the morning. So we're going to get you the numbers, the latest from DoorDash and Snap, and more right after this. Shares of DoorDash soaring after reporting second quarter results. Our Brooke DePalma joins us now from the Yahoo Finance newsroom with those numbers. It's actually rising. I was saying before we're seeing a lot of stocks declining. This is one that is not.
Yeah, this stock rising in after hours trading. Investors really focusing in here on that Q3 profit outlook. The company anticipates adjusted EBITDA come in between a range of $470 million to $540 million. That's above Wall Street consensus estimates of $449.2 million. Now, taking a closer look at this quarter, the company did post revenue that came in better than expected at $2.633 billion, surpassing Wall Street's expectations of $2.54 billion, that is. I do want to hone in on that adjusted earnings per share number. The company did post a loss per share of 38 cents. The company is saying that that's due to two one-time G&A expenses. One expense of $83 million because the company downsized a few of its bigger office spaces to fewer floors in this post-COVID hybrid work environment. That's in addition to an $85 million write-down in legal expenses as it settled pending cases this year. And with these write-down in mind, the company is working on that path towards profitability. Two key metrics I'm watching there include total orders. The company did beat their total orders, coming in at 635 million. Beating Wall Street's estimates of 627.3 million. And then marketplace GOV, that gross order value, coming in at 19.7 billion, surpassing expectations of 19.3 billion. And keep in mind, we're hearing from a consumer slowdown among so many other companies. DoorDash, its audience includes grocery stores, makeup retailers like Sephora, restaurants, and retail. The company right now not necessarily seeing a consumer slowdown similar to what we've been hearing from other companies. Our very own Brad Smith is standing by at the big board to chit-chat about Snapchat earnings. Brad, take it away.
Yeah, thanks so much, Brooke. We're tracking some absolute just nothing good here with Snap. Let's take a look at the shares here if we can, because we are down right now by a little over 20%. My last check here for shares of SNAP. Okay, all right, about 18, 19%. Here's what took place, though. They ultimately, on the earnings side, at least met the expectations, but it was the revenue that came in at a miss here. Taking a look at some of the line items, even though you did see some of the active user figures come in slightly above what the street was expecting here, it's the guide that investors are really upset with right now. And I was taking a look, doing a little mental math and, MacBook math, if you will, as well here, just looking at the midpoint of what investors were expecting on a go-forward basis here. And they were looking for this $1.36 billion Q3 revenue figure at the midpoint of this range that they provided. They're actually looking for lower than that just by a smidge. So all of that considered, that's going to be taken into account. It'll be interesting to see what the company says about that. But taking a look at some of those active user figures that I'd mentioned for you as well, 432 million active users, daily active users during the second quarter. The estimate was for about 431.17 million. So ultimately, they did come in just a bit above that. And taking a look through one other key item here within this press release, because of course there's a lot that the company really wants to kind of focus in on. Don't be surprised if you hear them on this call talk about some of the incremental improvement that they've been able to see year over year. It was indeed that on revenue base, on operating loss, there was improvements there. But at the end of the day, the guidance right now is really hitting Snap. And then one more thing here, as you're thinking about the milestone, reaching more than 850 million monthly active users, plus, oh yeah, it's an AI story that the company wants to tell as they're calling themselves a technology company versus a camera company, which is what we heard when this company went public back in 2017. A huge thing going forward from here is how they're converting for advertisers. And that's been the big question over the course of this earnings season so far, Julie, is how Pinterest, Meta, Snapchat are all going to lead conversions for a lot of those big advertising dollars that they're all vying for right now.
Looks like there's not a lot of confidence there in that stock reaction. Thank you so much, Brad and Brooke. Coming up, we'll be breaking the latest numbers from Apple as the iPhone maker is set to report its third quarter numbers. Stay tuned.
Checking in now on Apple's third quarter results. They are just crossing the wires, and let me get those to you. So Q3 EPS 140 versus the 135 that was expected. Revenue up 5% to 85.8 billion. The street was closer to 84.46 billion. So beats there on the top and the bottom. Gross margin hangs in there, 46.3%. That was better than expected. Turning to the segments, iPhone 39.3 billion. The street was closer to 38.95 billion. Services 24.2. Estimates were close to 23.95. Mac up 2% to 7.01 billion. iPad up 24% to 7.16 billion. Wearables, home and accessories 8.1 billion in the quarter. Finally, Greater China 14.73 billion. Estimates had called for something close to 15.26 billion. I did have the chance, Julia, to speak here with CFO Luca Maestri. Let me bring you Maestri's comments. Overall, he would characterize this as a very good quarter. It was a June quarter record, he said, on the top and bottom lines. By segment, he said iPhone revenue did actually grow when measured in constant currency. He also called out the installed base of iPhones, set a new all-time record, so that's important. He's referring there just to the number of active iPhones in people's hands all around the world. Of course, let's also talk about China, which missed expectations. Luca Maestri telling us, listen, we're seeing positive. One, he said business is improving as we kind of move through this cycle. In constant currency, he said the decline was actually less than 3%. So he's saying currency playing a factor there. All-time iPhone install base record there, he told me. Top 3 models in urban China were iPhones. They feel good about the business. Guidance, we know, will come on the call. Luca Maestri will give a forecast, at least color and commentary at that point.
It was very interesting to watch the stock reaction as you were speaking, because it was kind of bouncing around between positive and negative. And now it's a little bit more solidly positive here. Something to point out, just context-wise, when we look at the big picture for Apple, this is a rebound in sales growth, right? Because the company's sales had fallen for 5 of the past 6 quarters. So that 5% gain in sales, better than the 3% that was estimated, you know, that's got to be a relief for the Apple bulls out there. So that's something to point to. Of course, as you say, the forecast is going to be really important. And of course, to beat the drum, anything they say about AI and how AI is going to inform their next iOS, how it's going to inform demand for their devices going forward. It feels like that's really the other item that the street wants to get more clarity.
You can bet on that call, analysts are going to be all over that, trying any which way to get some commentary there.
Will they get any? We'll see.
We'll see. One more issue here, you know, capital expenditures, Julie. Just want to touch on that because there's a lot made. Apple's big tech rivals are obviously spending a lot on CapEx, building out these data centers to host AI services. So I asked Luca Maestri, just how are you thinking there in Cupertino about CapEx plans, especially to capitalize on the AI opportunity? Luca Maestri telling us, listen, we've announced Apple Intelligence. We've made all the investments we need to. We're going to continue making investments. He also reminded us that people compare us to these other big tech companies, but he pointed out, listen, we have a different business model and operating model. It is a hybrid, he reminds us. We do a lot of work in our data centers and partner, though, with others and use on their data centers. So he's just knowing the differences here between himself and others. People excited about Apple Intelligence. It is another reason to upgrade the iPhone, he said. Yeah. All right, let's get some more immediate reaction on this. Let's get to Tom Forte, Maxim Group Managing Director, Senior Consumer Internet Analyst. Tom, Apple's results are out. Let's get your quick take on the report. What do you make of it, Tom?
So for the June quarter, I would say it was a net positive with upside on both top and bottom line and better than expected results on the iPhone. So if there was one negative in the June quarter, it was, as you pointed out, that the revenue performance in China was weaker than expected. I do think, though, that investors are going to be hyper-focused on the September quarter outlook. If you look at the June quarter, when they gave their outlook, they did not actually give an outlook for iPhone sales. They talked about top line being up low single digits. They gave some color on services and iPads, but they didn't give specific outlook for iPhones. So with the expectation that you're going to have an upgrade cycle on AI, I really look forward to their commentary on expectations for September, especially for iPhones.
And what specific, do you think, as you say, we didn't necessarily get all of that color before. What are you expecting to get from Apple, and how do we, it's almost like the Jay Powell game. Like, how do we read between the lines of what they say?
So I think the ultimate story for Apple is that there will be an upgrade cycle for iPhones, which is still the most important product, half their revenue. The question is, how quickly will that start? Because there were headlines recently suggesting that they're going to have new hardware for consumers, assumingly in September, but they may have to wait for a software update to get Apple Intelligence to work. So how quickly are they going to see this upgrade cycle for AI? And I think they'll give us enough breadcrumbs to have a sense after they report after the earnings call.
Tom, you often hear bulls say, listen, a lot of this just comes down to Apple's installed base, the number of active devices in people's hands all around the world. In fact, Apple is saying their installed base of active devices reached a new all-time high in all geographic segments. And bulls, Tom, will say, listen, there's a lot of folks out there on relatively old devices, and they're looking for a reason to upgrade. And so Tim Cook's going to come to the stage in September. He's going to show you that new iPhone, faster processor, better camera, hey, some new AI features too. And the optimistic take is there's just so many people who are looking at this point. They're sitting there with a phone that's 2, 3, 4 years old, Tom, and they're encouraged to upgrade, and they're going to have all the reason they need to upgrade. What do you say to that argument, Tom?
So here's, I guess, why I have a hold in the stock, because you're looking at a PE north of 30 times versus the big tech peers at more like 27.5. And when you compare the iPhone trends before the 5G, there was actually a lot more pent-up demand for new iPhones leveraging 5G networks than I believe there's pent-up demand for artificial intelligence. So yes, I think you have a lot of devices out there that are in need of upgrade. The other challenge is regulatory. So when you look at Europe, which is about 25% of revenue, and China, which is about 19% of revenue, it doesn't appear that they're going to be able to launch Apple Intelligence anytime soon. So I think there's pent-up demand, a lot of consumers with older devices, but I don't know that we're going to see an immediate unlock with the iPhone 16.
And you mentioned China. Of course, even though Luca Maestri did tell Josh that things in China are trending better, the number itself did miss estimates last quarter. So what do you make of that?
I think China is still something we need to monitor closely. If you remember last quarter, there were a lot of press reports suggesting that things were materially weaker in China than they actually were. So I think China's holding up reasonably well. I look for additional details on the earnings call. But, again, I think the challenge will there be a major upgrade cycle if they can't have Apple Intelligence in China?
Tom, always great to have you on the show. Thanks for that instant reaction and analysis. Appreciate it.
Thank you.
Still to come, the earnings bonanza rolls on. We're going to get you the latest from Coinbase, Block, and MicroStrategy. Stay tuned. We're asking for a trend on the other side. A sharp sell-off on Wall Street as recession fears spook the markets. Let's get to Yahoo Finance's Josh Schaefer with the trading day takeaways. Josh.
Hey, Josh. Yeah, we had a big sell-off in markets today, and that really started off some economic data that we got this morning. So I want to dig into that here. Going to pull up a couple charts for you guys. So what we're starting with here is U.S. manufacturing activity. This was out from ISM at 10 a.m., and we saw the weakest manufacturing activity. You can see it coming down here that we've seen since November 2023. This was not a good sign, according to economists. You also saw within that index the employment index, so how many people are being employed in the manufacturing sector, ticking down significantly in the month of July. And then sticking with employment, we're looking at initial jobless claims here. So this is the amount of Americans that are applying for unemployment benefits in a given week. That ticked up more than expected. You can see a pretty clear trend here that we've been seeing moving higher. Weekly jobless claims hitting its highest level in 9 months. Now this, guys, basically sparking what we saw, if I can go back to my second takeaway here, that rate cuts aren't necessarily helping some areas of the market that we had seen. This is expectations for rate cuts. So we had that weak data that gave us a big move down in rates, but because that is coming from weak economic data, the market did not really take that in stride. A little bit of a shift from what we've been talking about overall with rate cuts. Of course, in the past, investors have been viewing rate cuts as sort of a positive for the markets.
And then, as we see what's going on here today, Josh, what else are you watching? Usually you have 3 things.
Yes, we do have one more thing, Julie, and I cheated and I used the earnings that we've been talking about all afternoon because I want to steal one of your points that you made, Julie, that I thought was rather important going into tomorrow. So we've had just a divergence in big tech earnings over the past week and a half now. So you have some companies that have been received well, some companies that have been received a little worse. You look at Microsoft was off a little bit the other day. Alphabet wasn't necessarily loved to a full extent. Apple is up about it's just barely positive, and now it's negative after they just reported earnings. We're looking at Amazon down 6%. And I guess what I'm sort of getting to here, guys, is when you have a market sell-off like this, you would sort of look to the earnings reports after hours to maybe instill some more confidence in investors headed into tomorrow, headed into this jobs report. We are not getting a clear picture of that in the after hours action today, so it'll be interesting to see how that sort of plays out. But there was perhaps feeling that maybe corporate results could give us a little bit more confidence headed in tomorrow, and that is just not the picture we're looking at this point.
It's interesting, Josh, because the stories, they're sort of just, in a sense, people kind of picking their spots. Like Meta had, pop today and looking like 5%. I thought Dan Gallagher over the Journal, he had a good post about how, if you were to kind of pull back the chart, investors have usually given Zuckerberg some leeway as long as the core business holds up and, you hold other costs down. It's just interesting how, there was the big AI trend and theme and hype, and now maybe, seeing some possible evidence that investors are becoming more discerning.
Yeah, Josh, just looking at Meta's trading action throughout the day today, you mentioned normally they see a little bit bigger of a pop. The stock was up 8%, right? When did it start coming down? It's when we talked about sort of that overall market shift at 10 a.m. And so really the stock was a little bit resilient. It wasn't the big move that we might have normally seen. But for Meta to be up 5% on a day when, again, we look at the rest of the Nasdaq 100, one of the only large cap stocks in the green for the day, it showed a little bit of resilience. So it'll be interesting to see how that carries forth after we hear calls from Apple and Amazon headed into tomorrow.
Josh, thank you. Appreciate it. More earnings coming across the wire from Coinbase, the company reporting better than expected second quarter revenue, the stock edging higher just by 1.5%. Now, a couple of things to note here. Revenue was up more than doubling, in fact, year over year to $1.45 billion, which was ahead of estimates. But the company also highlighted what happened quarter over quarter, that it fell 11%, and that's largely because crypto was down quarter over quarter, right? It peaked earlier in the year and then saw some declines over the course of the quarter. So the Coinbase points that out here, does point out that operating expenses also rose quarter over quarter. So that's something to highlight as well. Trading volume, $226 billion. That did beat estimates. It looks like both on the actually retail trading volume a little bit short of estimates, but more than it made up for by institutional trading volume, which is quite interesting here. In the third quarter, subscription and services revenue going to be $530 to $600 million, comparing with an estimate for about $565 million.
Yeah, we were talking about this off camera, Julie. They also take a beat and emphasize what they say is extraordinary strides in achieving regulatory clarity, which they say serves as a vital unlock for Coinbase and the broader crypto economy. So they're going to continue driving this forward through the fall elections and beyond. And of course, we talk a lot about this, how really politicized the asset class has become, or at least certainly such a discussion point in this election.
Yes, most definitely. Let's get to some other sort of crypto adjacent numbers, shall we? Specifically in fintech, Block and MicroStrategy, both reporting their second quarter results. We've got a mixed reaction. Those shares, MicroStrategy not moving much. You could argue it probably moves more on crypto than on the results themselves, perhaps. And Block shares up about 4.4%. So for more, we're bringing in Mark Palmer, Managing Director and Senior Research Analyst for FinTech and Digital Assets at Benchmark. It's good to see you, Mark. So as we look at these numbers here, let's start with Block and kind of what stands out to you.
Yes, good to talk to you, Julie. This was a better than expected quarter for Block pretty much across the board. And while the company did have a headline revenue miss, most of that can be attributed to Bitcoin revenue. And frankly, I think that the street failed to make an adjustment for the fact that, as you mentioned a few moments ago, crypto and Bitcoin were down during the quarter. Beyond that, the company really had a solid quarter, both in terms of top line and especially in bottom line. Adjusted EBITDA, adjusted operating income, adjusted EPS, all solid beats, and the company raised its estimates for the year across the bottom line. In the past, Block had been much more of a top line story. It's really become a bottom line story, and we're seeing the impact of the company's ability to create operating leverage and drive that through its whole system. With that said, this stock has been lagging. It's down something like 23% year to date, but the operating performance continues to be solid. The outlook is strong, and so we think that Block is a good buy at these levels.
Mark, we were talking about Coinbase earlier. I know you don't cover that name, but just get your thoughts on Bitcoin generally. I'm obviously up so very strongly this year, Mark. Those new ETFs sparked so much enthusiasm, but then kind of cooling since hitting that record in March. And I'm just curious, Mark, where you see it headed in the near to just kind of intermediate term.
Yes, I think we're bullish on the outlook for Bitcoin. And of course, we have a buy on MicroStrategy, which reported today after the close. The underlying dynamic here is really one in which the Bitcoin halving, which occurred in April, still, in our view, has created a nice setup for Bitcoin's price going forward. Typically speaking, after a halving, and there have been 4 of them, the one in April was the 4th in the history of Bitcoin. There's a significant rally over the next year and a half or so in the cryptocurrency. We've begun to see a little bit of that, but it's been a muddled path. And I think part of that is technical. We had some large amounts of Bitcoin that were set to be sold into the market, a large chunk of that coming from the disbursements coming out of the Mt. Gox case from long ago. So it has created more near-term supply of Bitcoin in the market. But bigger picture, we think it's just a question of time before more institutions begin to adopt Bitcoin. I mean, on the pension fund side, we've seen 3 large entities that have gotten involved. The state of Michigan, the state of Wisconsin, and Jersey City, New Jersey have all invested in Bitcoin, spot Bitcoin ETFs. You're seeing a lot of tire kicking going on out there among institutions. It takes some time for a pension fund to arrive at the choice to add Bitcoin to its holdings. But again, these spot Bitcoin ETFs were only introduced to the market in January. We think that this is a trend that is going to be long lasting.
Just quickly, I wanted to ask you about something else that Coinbase mentioned in its statement, which is what it says that Coinbase and the crypto industry made great strides towards achieving regulatory clarity in the U.S. I don't know where they're looking at that regulatory clarity, because I don't see that regulatory clarity. Do you?
I think it's been showing up at least on the margins. And I think it's also a relative thing because the past few years we've seen the U.S. government and the SEC in particular, really cracking down on the space, including what was known as Operation Choke Point 2.0, where it was very difficult for any company involved in crypto to get access to the traditional banking system. But we've seen a couple of big developments. One is, as I mentioned, the approval of the spot Bitcoin ETF in January. More recently, the approval of the spot Ethereum or Ether ETF. And also even in the SEC's proceeding against Coinbase and some of its other proceedings, it has taken a step back and has refiled its motions so that it is stating to the court that a wide range of different cryptocurrencies, which it had previously said were securities, should not be characterized as such. So these are modest steps. They may frankly be driven to some extent by what's going on in the political realm, where you do have a large portion, or it's actually a large number. The portion's much smaller. It's something like 14% of Americans who hold crypto. But still, that's an important constituency. And I don't know that either one of the major parties wants to alienate those folks right now.
Right.
Mark, great to have you on the show today. Thanks for taking the time to join us.
Thank you.
Coming up, we're going to get you caught up on a few more tickers that are moving after hours. More ask you for a trend on the other side. Let's take a look at what's trending after hours. Shares of Roku jumping after hours following a beat for the second quarter revenue as the streamer benefited from strong ad sales. Streaming hours for the quarter grew 20% year over year, while active customer accounts jumped 14% in the same time. Guidance for the third quarter came in line with the street's estimates.
Shares of Twilio higher after beating across the top and bottom line in the second quarter. The company's forecast for the upcoming quarter also a bright spot. Twilio sees adjusted earnings per share for the third quarter in a range of 81 to 86 cents, well above the Bloomberg estimate of 72 cents. The company did narrow its full-year organic revenue guidance to 6 to 7% versus the previous 5 to 10%.
And DraftKings announcing Q2 earnings. The sports betting platform reporting revenue of $1.1 billion, just under Wall Street estimates of $1.11 billion, and a miss on adjusted EPS at 22 cents versus an estimate of 25 cents. DraftKings boosted its revenue guidance, though, for the full year. Guidance beat the average analyst estimate. And that is a wrap on today's coverage, and what a day that was. One last check here on some of the earnings we broke earlier, including numbers from Apple, Amazon, on Intel. Apple's call going on very soon here, in which, of course, investors will be focused on what guidance Tim Cook and Luca Maestri have to offer.
And in Amazon, really the focus is going to be on for that third quarter guidance. Why is there this expected revenue and operating income shortfall? What are the inputs to that, and why is that going to be happening? And of course, all of this could be moot in terms of the stock action when we get the jobs report tomorrow morning at 8:30. That's going to sort of sweep the macro narrative away, but it is interesting to see pressure on many of those big companies that reported, with the exception of Apple.
For sure. All right, be sure to come back tomorrow, 4:30 p.m. Eastern, for all of the latest market moving stories affecting your wallet. Have a great night.